Thank you. This panel has been challenged with thinking big. That's actually quite nice. When I listened to Sophie, your numbers here earlier on, and your numbers were truly big, at least those initially. Thinking big from billions to trillions, and that's a lot of zeros. It's a tall order. It's easy to think, and it's somewhat more difficult to execute. And our task here today is to think about and discuss what it takes and how we can propel this forward in a rapid, sustainable manner, avoiding pitfalls along the way. And I'm sure we'll have a few of those pitfalls, but how do we maneuver as well as we can? It's important for poverty alleviation, and there are lots of opportunities, so it has a lot of implications that we actually succeed in this. We have a highly competent panel to shed light on this topic, and I've asked each of the panelists to give a short and brief introduction, and then we'll discuss this in greater detail. Two of you, Anne and Sophie, you've already been on. You can say a little bit or as much as you feel is appropriate. And then we'll kick off with Els and Eric, and then moving on to the two of you afterwards since you've been on. So with that, Els, why don't you start and give a bit of your background with an experience from Goodwill.
Yeah, okay. In short, Goodwill, the metaphor we tend to use is we are a bridge and we are building a bridge. We were founded more than 10 years ago. Personally, I was working in FMO as an investment officer managing a portfolio that bankers would call toxic. And even people within FMO were laughing about it. It was toxic. But we had the likes of Equity Bank, Akleda Bank in Cambodia. I think a lot of you know these success stories nowadays. So, you know, we were dreaming like it's real business, it's good business from multiple perspectives. Great entrepreneurs, local solutions for local problems, and a lot of capital, it was before the crisis, looking for good opportunities. And people showed an interest in projects in emerging markets. So we wanted to build a bridge to make, you know, both worlds connect. Poverty is a big issue still. We're moving in the right direction. Let's not forget that. We're really making progress, but it's big. And if you want to solve it, and it's urgent, you must think big and try to tap into mainstream capital markets in a responsible way to tackle the issue. And that's what we're trying to do, build a solid bridge to channel more capital to entrepreneurs with great ideas.
Excellent, Els. Eric, why don't you...
Yeah, so my name is Eric Sanderson from Noir Finance. And Noir Finance was mentioned by Deepak in the previous presentation as the sort of Norwegian DFI owned by the government, the Ministry of Foreign Affairs. So we've been in operation for 20 years or so and investing in private enterprises, trying with the same objectives really as Els was talking about, trying to alleviate poverty, create jobs, and make these economies grow. And financial inclusion is obviously one of our key development objectives as well. So we are investing quite a bit in financial institutions. And while we have our own targets and what we're doing there, DFIs can play a role in providing capital to these markets. Since we have that as our mandate, we are there in good times and bad times. If you look at FDIs to foreign direct investments into these countries, the DFI component is growing steadily while there's more fluctuations in other types of capital. So I think we have a stabilizing effect and hopefully a growing importance in the markets. But we, of course, cannot provide the trillions. Norfund has investments under management of close to $3 billion. So we're on the billions number, not on the trillions. And I think that's what we should talk about in the panel, how we can go about reaching that number. And we're trying as Norfund to set up public-private partnerships to reach that goal. And I can talk more about it later. But Arise is obviously one prevalent example of how we try to do things.
Very good. Thanks, Eric. Sophie, would you like to add a little bit to what you said earlier on into the start of the panel?
Yes, certainly. I mean, before I started being an entrepreneur, I spent 25 years building banks. And I'm an engineer, I'm an information scientist and an amateur economist. So I bring the tools that can help to resolve some of these problems. And one of my observations when I look at capital markets is that we have a pipeline problem at both ends. We have, particularly in emerging economies, a challenge with investing at the ground level because of the lack of formal businesses, because of the lack of traceability, because of the lack of auditability, because of all the problems that are on that slide just now saying, corruption, etc. And we have a problem at the institutional investor end where the risk appetite is very, very limited. And we also have an imbalance between, I mentioned sleeping capital, the availability of sleeping capital and the availability of retail people to get involved with the investing in the small markets. I know that we've had peer-to-peer investment platforms which have had a certain degree of success, but there's a lot of opportunity, and we see the emerging technology of things like security token offerings and blockchain-based bonds as being a significant vehicle and a real game changer in engaging both ends of this pipeline in releasing additional capital into these markets as an investment and as debt instruments to create growth on the ground. And really not necessarily bypassing financial institutions, but complementing what financial institutions do.
I can reveal that you don't see what's on the back of Sophie's T-shirt there, but it says, the world does not need another bank. Is that correct?
I can turn around if you like.
Okay, Anne, would you like to?
So I mentioned MasterCard Foundation earlier, and the 20 billion that's in there. Well, it's over 20. It's about 23 billion now, I think. And obviously, we use a lot of that money to actually fund many of these projects that you see across Africa and so on. One was referred to by the last speaker. Apart from that, MasterCard committed to bring the next 500 million people, 500 billion people, getting my billions and millions mixed up here, into the financial system. We made that commitment in 2015. We've so far run projects that bring 370 million people into the system. This involves investment in infrastructure, working with NGOs, working with governments and so on. So quite a lot of investments to build those ecosystems to get that done. And then apart from that, in the technology space, I mentioned that we work with many startups, and perhaps we look forward to working with Sophia. But what we have seen from our startup community is that of 190 companies that we've worked with, they have themselves raised 1.2 billion capital. And we are now working with a company called Astia Angels, which is actually investing in women-led startups. So we think about this space in many different ways, both transactionally, infrastructurally, funding-wise, philanthropy. So there's many different strings to the bow here.
The interesting thing is we see here a market where the people that currently mostly provide the money are public money, philanthropic money, and then you have pockets of other sources, commercial money, but yet in fairly limited amounts. So you represent a large corporate with very substantial muscles, a startup with for-profit impact investing or social impact investing. I noticed you said that. I'd like to get back to that, Sophie. And then slightly more mainstream impact investing for profit and with focus on financial inclusion. If I start with a question for you, Els, and with your experience from Goodwill, from both mainstream investors and also raising money from public money or government money, what are the current trends that you see in the funding market, and how do you compare and contrast that, and how do you feel that can contribute to us reaching the trillion number?
It's changing rapidly, which I think is very good news, and it's really scaling, and that's what we need for this big, urgent problem. We started in 2006 with 3 million euros from private investors. Very soon, IFC and FMO supported us, a few Dutch pension funds, and a Dutch green bank called ASN Bank. So we always had a mix of public and private money. But right now, 2019, the private money is overtaking the public money rapidly. The tickets are getting bigger. We have one family with 12 million euros invested in our fund. I expect another one to join a family with 10 million next week. DFIs can't even keep up with it, so that's really interesting. We see other names in the space like BlackRock, TPG Rise. Some people start raising their eyebrows. Yes, there will be scandals. Yes, it's getting busier, but we need that. It's growing pains that we need to overcome. And I think, there's a role for true impact investors to also make sure that it is about a mission, because if you want to have success, you must be mission driven, and you can have good results. And we see at Goodwell that results are being recognized, and that private money is overtaking public money, which is a dream come true, I think.
That's very good and interesting. By the way, I encourage you to throw in questions.
I think on that impact investing side, I was recently in Israel just before Christmas and had the opportunity to meet Sir Ronald Cohen with Shami Peres. Mm-hmm. And they were talking, Cohen was particularly talking about how in the future companies can no longer be measured by their bottom line. That he saw that a company making, say, 10 billion and having a negative impact on the world would be valued much less than a company making 10 billion and having a very positive impact on the world. Yeah. So these two things, the impact and the bottom line, are now becoming very intertwined, which is a great thing. Yeah. Because it's causing, the big companies around the world to pay attention to this. And that's why I think that you're seeing this, this rapid rise in more money going into this space.
Yeah, new money coming from fintech entrepreneurs, new generations, millennials. For them, it's a no-brainer, that fintech in Africa is important, or that you need to do, good things with your money, and that profit and purpose can be combined if you're long-term oriented.
I think the other thing that's exciting, carry on. The other thing that's exciting is that we're reading that more and more money is shifting into women's hands. And the reason for that is, women are living longer than men. We have for a while, but also that, the inheritance, it's a fact. The inheritance laws have changed so that women are now inheriting more money and so forth. And this is then causing a shift. And the stats from America are saying something like, once women inherit the money, they change their financial advisors within 12 months. That's pretty interesting. And there's a thought, and I don't have the data on this, that there's the thought that like millennials, they'll start paying much more attention to how the money's being deployed for social good.
It's true of women at every level. I have to say the entrepreneurs that we work with in Niger are known to invest in sustainable businesses that benefit the long-term survivability of their communities. And these are, micro entrepreneurs who have very little, but give the money, and the lenders, we're talking about investment at a local level here. The lenders want to reach this market because A, they know that these women have a 2% default rate, or less than 2%, which is phenomenal. And B, because they will give back to the communities that they support, because each of these women is supporting between 5 and 15 people. Yeah. And what they say is you give it to the guy, he'll go to the big city, maybe make a business for himself. You give it to the woman, you're giving it to the community. And yes, it's obviously a broad generalization you can extrapolate, but if you're looking at a developing economy, my view is that these communities are actually a massive investment opportunity. If we can create the transparency that products like ours are creating, then we can start issuing community bonds for communities which have a very low default rate, which have a great sustainability agenda, and they're already there. So Lena's community in Niger is 600,000 strong. 80% of them are women. And they're already functioning brilliantly as a community. So all they need is a bit of cash. And funds like yours could easily invest in these communities if we can create the traceability and we have the right investment vehicles to do so. And that means not overcoming, but actually circumventing the traditional barriers, which are about lack of transparency and perceived risk.
I'll ask a question to Eric, but it's actually for all of you. At Voxtra, we were doing impact investing, and our claim was that we were going to deliver both social impact and financial return. And we were challenged that we would probably be likely to either succeed in one or the other, but not both. So you cannot deliver both social impact and financial return. Is there a positive or is there a negative correlation between financial returns and social impact? And it comes back to your bottom or triple bottom line thinking from Ronnie Cohen. But Eric, why don't you start and the rest of you can throw in.
That's a large question, obviously, and I think maybe in the long term there is a correlation. I think in the short term there's not necessarily a correlation between those two. So and there is not necessarily a correlation the other way either. I mean, it's not that you have to choose one or the other. So how we are looking at this in Noir Finance at least is to say, our purpose is to have the social returns, the social impact. That's why we exist. That's what we should do, and everything we do should have that as the mindset. And we shouldn't do anything that we don't think contributes to that. But then, having set that and put that, up there and aside, then on a day-to-day basis, we operate on doing the most profitable investments we can do. That's the only way we can operate, on a day-to-day basis. Otherwise, sit there and juggle between, social returns and commercial returns. That's, an impossible task to do at any point in time for individual decision making. So we have to, choose the direction, choose the purpose based on the social goals, and then I think if you do that, then there is a positive correlation. Not that you necessarily optimize both of them at the same time, but at least you go in the right direction on those two dimensions. That's how I see it.
I would also include, to your point, the natural capital accounting side of things, that if you can actually measure externalities and benefits to the sustainability of the environment and the value chain, your sums look very different. And one of the really positive things I'm seeing after Davos now, we presented a paper for the Sustainable Digital Finance Alliance, which really trips off the tongue. And in partnership with DBS, we were promoting how natural capital accounting can be combined with traditional types of instruments to really demonstrate where the value is being added. And what we're also seeing, going back to is there a correlation point? If you look at things like ETFs, exchange-traded funds, which are tracking indices, there are a lot of sustainable ETFs out there nowadays, which are being bought by normal people and traded by normal robo-advisors. And the reason that people are buying them is not just because they're good for the planet, but because they're generating returns. And those returns are comparable to standard instruments. So I think this argument that you're going to throw away your money, but it's doing the planet good is an old argument. Yes, there are still some challenges in expressing how it's benefiting long-term investments, but we're seeing more and more very positive financial rewards from these investments, and you can go out tomorrow and invest $100 in an ETF via a robo-advisor and you will see your money come back. So.
You brought up something else that I would like to touch upon here, and several of you are suited to answer it. But financial structuring, you mentioned it, creative financial instruments, first loss structures, etc., etc. Are they a good thing? Are they a temporary thing that we need, but we don't want long term? How do you think about that? And whomever moves first. Eric?
As I started off saying, we're trying to get some of the large asset managers and sort of professional investors to get into this space. And it's difficult. I'm glad to hear your story about that there are pockets of money coming. But I think still it's a bit of a long way to go to get really the large, pure for return investors that are really making up the large numbers to do this. We have set up structures like Arise, like the Nordic Microfinance Initiative, with some with Norwegian family offices, very much has the same mandate or interest in social impact and social returns, and those are but I think it's still individuals with that passion that drives it more than the general sort of, if you talk to sort of like the sort of investment managers level at many of these institutions, they are still limited by their investment mandates. We don't invest outside of OECD. We cannot do things because of corruption risk. There's a lot of these things that are inhibiting people from doing it. So I think we as DFIs try to make play a role as a sort of stamp of approval on some of these things, and then I think what you're getting at is sort of like, what about this whole blended finance idea around first loss and so on to get in? I think it is necessary at this point to get the larger ones to large sort of standard asset managers and investors to enter into this space. I think you need it to some extent. I'm personally very ambivalent to this. I think it's a big risk also in doing it, because you distort markets. It's basically a subsidy, but it is necessary in certain times. And we heard earlier, I think today, with the conversation with you and Nora about good examples where you can actually seed it and then can pull it out. The key thing, as you said, is that you can actually pull it out, because if you can't pull it out, we keep doing it. It's not going to demonstrate and prove to the world that these markets actually can deliver the return that we want them to convince everybody in the long run. So I have a bit of an ambivalent view on that.
Yeah.
Any reactions to that?
Well, I'd say green bonds are an interesting area. I mean, on the one hand, they've moved from 0.2% to nearly 2% of the market within about less than 10 years, which is pretty impressive. But a lot of that movement is because of China, who really don't do transparency. So, yeah, I agree. I mean, I think incentives are good. I think that there is a place for them, and I think it helps. But the issue you talked about really is culture as much as anything else. And I think that to an extent we're going to need to wait for a generation of investment managers to die before we see significant change, because changing culture is really hard. I mean, we've seen a lot of innovation in financial instruments over the last 10 years, particularly in the sustainability space. I mean, the stuff that's been done in Sweden is amazing. Stuff that's been done here is great. But it's all quite local, and as you say, it's people who are passionate about it. And I think while I believe as an engineer that creating transparency will provide the opportunity to create new instruments, to create new transparency, to make these investments possible, culture is the big thing that needs to be changed. Having said that, we always think things are going to move slower in the next year and faster in the next 5 years, but we've already seen the World Bank issuing its first blockchain-based bond, which was massively oversubscribed. That was in October. Since then, we've had a load of other businesses and social impact type businesses starting to move into this space. Germany just authorised its first security token offering for a fund manager that does investments into micro businesses globally. So it's starting to happen already, and I think we will see that change evolving very, very rapidly, actually, over the next year and a half.
I don't disagree that it's a culture change, but I do think that if you want to mobilize the big money like the pension funds, they are always going to be very risk averse because they're dealing with people in the streets' money, and you want them to be risk averse. You don't want them to be investing your pension fund in something that's going to evaporate overnight, because that's going to be a bad thing. So I do think that the financial instruments and the way that they're structured to create a certain level of safety is very important. Otherwise, you'll never mobilize that money. I do think that more innovative minds coming into the industry and trying to figure out, how do we do that? How do we create that win-win situation? How do we put seed funding in that you can take back out and use to seed something else? This has to be thought of, and the brightest minds have to be thinking about this. I think there is a way forward for that.
Yes.
Yeah, I'd like to take a slightly different approach here, because we're now talking about, channeling money from the West to emerging markets, but there are domestic capital markets out there as well. And it was mentioned today, Africans, Indians, they do save. There is money in those markets. For me, the ultimate story is if domestic capital markets can, take over the role. And one of my favorite stories is Green Kuta in India. It was a traditional NGO, and it also had a credit component. In 2008, they decided to split off the credit component with 100,000 clients into a microfinance institution, regulated. We invested equity at the time. We sold it in 2014, but they went for an IPO last year. So that means that now, to a large extent, they are financed by domestic capital markets. So it started with philanthropic money from the West, then it became commercial money, still from the West. That started to come in locally, and now it's listed in India. And I really think, that is what we should try to achieve in the end. I would love, to turn off the light at Goodwill one day, destroy the bridge, because local capital markets are doing the job. And that's why I think what we should use subsidies for.
But I think also it's a difference between actual risk and perceived risk by many of these investors. I mean, I've spoken a bit to FMO about, they're raising these debt funds, and we've tried to do the same here in Norway. We do, debt to banks in Africa and also the other countries. Probably some of the least risky things we are doing, and the loss rate is, is minimal. For FMO, it's like 0.2% annually loss rate, and they have done this for decades. Still, if you go to, and they have yields maybe of like 6 to 9% on individual loans. If you go to a Western pension fund with that, they would say, "Oh, but it's Africa. I can't do it." I mean, these returns are fantastic for that loss rate. It's fantastic, but it still doesn't fit the big picture. And they say we'd rather put the money in the future, bonds in our own markets, even though that's much more risky, because the diversification you get through some of these, bank debt funds is much better. So I mean, there is a mindset that has to be changed also, and that's we have tried this in Norway. Talked to some of the larger banks, institutions, investments bank, trying to talk to investors. Zero interest. They don't want to do it. It's too low and low returns. And even we tried, some financial structuring with different, tranches, so junior, senior tranche, and so on. It's still the risk-return trade-off just doesn't fit the mainstream investor. It still has to be driven by passionate people, which, Deepak earlier mentioned Rabobank. I think Rabobank is a very good example, but there are some passionate people there actually wanting to drive this agenda.
Responsibility in Switzerland, I think 4 billion, 5 billion, it's completely private money.
Not completely, but I mean, Responsibility is doing a lot of good on this.
Yeah, and I completely agree. I mean, I think it is about, it's about the rules, and if you're dealing, let's face it, if you're a pension fund, you can't put money into a junk-rated country. And that's where I think transparency and creating avenues for investment which demonstrate the kind of returns that you're talking about, which absolutely do exist. I mean, the less than 2% default rate in these lending circles, the banks you're talking about, they're great investment vehicles, but we've got this big problem, which is the rules say no, computer says no. And it's partly cultural, but it's also due to a lack of alternatives. And that's where I think, to your point, innovations like the things that we're doing are part of the equation, but they're not everything.
No.
So innovation needs to be mixed with culture. Culture change is really tough. I know I've done it in a lot of banks. So I think they both need to happen.
And could I ask you a question? I think you said in a tiny little sentence during your presentation there that you were a tech company or a fintech company.
Yeah, absolutely.
And when we think about you with $250 billion market cap, was that it?
230 billion. Yeah, I don't know what it is today.
Maybe it was pounds or euros. You are one of the real big dragons in this market, and yet you consider yourself a fintech. How do you manage to work like that with such a size? You have certain tremendous benefits being at that size, strength not only in terms of capital, but also in terms of competence, insight, data, et cetera, And on the other hand, you have what we oftentimes think of as fintechs. They tend to be small and nimble and creative and other things we can think of. How do you work with or compete with, and to what extent do they nibble away from you, and to what extent do you roll over them or work with them to make sure that we get the most out of that pool of competence?
Well, I mean, first of all, although we're a very big market cap company, we don't have like massive numbers of employees. I mean, we've got, I think, over 14,000 people around the world in over 210 countries. So, you know, you'll go into some countries and there'll be half a dozen people. I mean, it's, you know, nothing. Kind of thing. Obviously, our big tranches of people are sitting in some of our big tech centers in India or, you know, in St. Louis or wherever they happen to be. So we're a small, you might think 14,000 doesn't sound small, but just compare it to, you know, the size of some of the banks and then look at the market cap difference. We're a small company with a big market cap. That's one thing. And then the other thing is to keep ourselves nimble. Obviously, we can't be, you know, changing our systems every 5 minutes because we're moving trillions of dollars around the world in real time. So whenever we do a change inside our core systems, it has to work. But, you know, we recognize that we've got to be able to innovate. So what we did was we set up labs all over the world to be able to do these innovations. Started in Dublin, you know, you've got Singapore, you've got Kenya. We set up a lab in Africa in Kenya in combination with the Gates Foundation. So we could design products for people who are earning a few dollars a day and actually have Africans design products for Africans. So by taking this kind of approach, it then allows us to be small enough, if you like, to start interfacing with startups that are also small. And because we can take pieces of our network and effectively put it into a sandbox that people can experiment with, that's how we can move faster. And actually, we can move very fast. One of the reasons we can move so fast is we upgrade our network several times a year. That doesn't sound very fast. But if you upgrade it across 210 countries simultaneously, that's really fast. So it's this network design. You know, everybody's saying, like, it's great to be a network today. We were created 60 years ago or something. But the design of it is really modern, if you like. And blockchain, by the way, we've got over 60 patents in blockchain, and we built a blockchain from the ground up that can run MasterCard, right? And we can even get the speed that we want, although it's not completely open loop to get that speed. Blockchains can be pretty slow if you have to go completely open loop. But many other players in the world are just not ready to engage with you on blockchain. So the problem is to build anything of scale there right now. That's not really there yet. And blockchain's a technology, it's not the silver bullet. By the way, I was sort of also thinking, you mentioned you don't do Bitcoin. Bitcoin, somebody was saying to me, you know, about, oh, well, Bitcoin might be cheaper and more ubiquitous and so on. You know, and I was saying, have you figured out how much power you use to mine one Bitcoin? You know, it's something like, I don't know, some Dutch guy calculated that it was the same cost to heat his house for a month to mine one Bitcoin in terms of energy, power usage. And I think that, you know, you have to stop getting fixated on this fee or that fee in a bank and start thinking about what are you actually doing to the sustainability of the planet here with some of the technology that you're actually designing. It's a very interesting question. I'm kind of digressing, I'm sorry, but I just find this whole area very...
How much CO2 do you need to produce a Bitcoin? Somebody can
It's
calculate
elementary.
that.
It starts with the thinking about impact.
Yeah.
I know we were running towards the end of the panel. I sort of, we have not talked a lot about public-private partnerships and government money and its role in bringing us from billions to trillions. And the reason I didn't bring it up earlier was that I really believe that one of the consensuses in this panel is that if we want to move to trillions, we're talking mainstream capital markets. We're talking a proper return for a proper risk. And if we're not getting there, we will have our billions and we'll do well. If we get to the mainstream capital markets, we will have the trillions and we'll make an entirely different impact than moving with the billions.
Absolutely.
On the public-private partnerships, since, Eric, you're representing Noir Fund and you have a bit of experience in that, is there anything you would like to add on that, just so we touched upon it?
I mentioned a few things already, but I can say this a company called Noir Finance that we set up, which was mentioned, is now a shareholder in Arise. We brought the idea there was, create a joint venture between Norfund and some private investors in Norway to that wanted exposure to the sort of African financial services market and go about doing it. It was a tough job to raise that capital. The main sort of investor is KLP, the same, there's a pension fund that's mentioned. But initially we also had two other investors, a normal sort of mutual fund investor and the family, a wealthy private individual. Very keen to get in. Then, 2 years down the road, both wanted to get out. It was, for the private investor, it was like, oh, there's some other thing that is more interesting right now, I want to do that instead. And for the mutual fund, it was just didn't reach the performance targets over that time period that they've had. So they exited. And I think, that's fine, but, you need to have investors that have the true interest in this and has the longevity to actually go with it and the stomach to target, to handle the volatility and the uncertainties, because these are longer time frames than maybe some other investments. So find the right investors. I think it's because not everybody is there yet. That's for sure.
Any other final comments from the rest of you?
No, yeah, maybe just the good thing is that interest rates, at least in Europe, are so low.
Yeah.
Leaving your money on the bank is not an option, right?
Yeah.
Having money is a problem. And so, I think that's an opportunity, definitely.
Yeah, I absolutely agree. And nowadays, the opportunities for investing, whether it's a peer-to-peer investment, whether it's participating through a robo-advisor, as a private individual, are so much greater. And it's so much easier. So, as I said, I think that end of the pipeline is also going to grow, and it's something I would encourage everyone to look at. I was speaking last week to a group of women about investing as a woman, and everyone was saying, I don't understand investments, it's too difficult, I don't know which questions to ask. And actually the same applies to all the men I know who invest anyway. So, even if you don't really understand it, just read up some stuff, go and do it, it's really easy.
Right.
Sorry, that was a digression. But yeah.
On that happy note, I know lunch is next, so I think we're going to round off. I would like to give an applause to the whole panel for having had an interesting discussion. And thank you.
Thank you.
Thank you.